Let's go ahead and talk about intercompany sales of depreciable assets now. Hopefully I'll be able to get through this whole thing without anybody banging on my door or calling me on the phone. Okay, we started these intercompany asset sales discussions with the sale of land, since land doesn't get depreciated. That makes it a lot simpler. All we had to worry about each year was restoring land to its true cost and adjusting the investment and non-controlling interest accounts. In the case of a depreciable asset, it gets a little more complicated. Now again, our goal is to make it appear as though the intercompany sale never happened. The problem now is that the reported asset value, the reported depreciation expense, and the reported accumulated depreciation all have values which differ from what they would have been had the sale not taken place. Not only do we have to adjust the specific asset account back to its true cost, we also have to adjust depreciation expense and accumulated depreciation back to their true values. Let's go ahead and start with an example. Assume that Big Company owns 80% of Little. Big has equipment which they purchased for $100,000 back on January 1st, 2007. The equipment was expected to have a useful life of 5 years with no expected salvage value, and let's assume straight line depreciation through all this. So $100,000 minus zero salvage over 5 years would be $20,000 annual depreciation. And let's assume that after 2 years, on December 31st, 2008, Big sells the equipment to Little for $75,000. The total expected useful life and salvage value are going to be unchanged. In other words, the asset still has 3 years of life remaining. First, it's important to note this is a downstream sale, so the fact that Big owns 80% of Little is completely irrelevant. Again, if it's a downstream sale, the entire effect of the intercompany sale accrues solely to Big Company. It has nothing to do with the non-controlling shareholders. So first, let's go ahead and figure out the gain or loss on the sale that Big would report. The asset cost them $100,000, less the accumulated depreciation. Again, it's now 2 years old. It's being depreciated at the rate of $20,000 per year. So accumulated depreciation is $40,000. So it's got a book value of $60,000. They sell it for $75,000. A gain on sale of $15,000. Now again, in the case of the land sale that we used as a previous example, the gain was realized when the asset was ultimately sold to a third party. This asset is not going to be sold though. It's going to be used up over the 3 remaining years of its useful life. The gain is going to be recognized over those 3 years as the asset gets consumed. So $15,000 gain recognized over 3 years at $5,000 per year. And we're going to recognize that gain as an adjustment to depreciation expense. And this will make more sense as we go through the example. Okay, let's go ahead and record this sale on Big's books and on Little's books, and see where we stand at the end of the year when we're ready to do the consolidation. Now, since the sale occurred on 12/31/08, the 2008 depreciation expense has already been recorded by Big. So to record the sale, again, Big receives $75,000 in cash. They take the equipment and its accumulated depreciation off the balance sheet, and they record their $15,000 gain. On Little's books, they're going to go ahead and record the purchase of equipment for $75,000. Let's also see what depreciation expense is and what it should be. Now again, starting next year in 2009, Little is going to report depreciation expense of $25,000 per year. They're going to take their $75,000 asset, divide that over 3 years for $25,000 per year. The correct or true depreciation expense should be the $20,000 per year that Big has been using. So again, one of the things we're going to need to do is adjust depreciation expense from the value that's being reported by Little to the true value. We're going to reduce depreciation expense by $5,000 each year. And that's the way in which we're going to recognize the $15,000 gain. Again, $15,000 spread over 3 years, $5,000 per year. Okay, let's go ahead and do our year of sale equity method entry. The $15,000 gain on sale is unrealized, so we need to reduce our investment income to offset it. Since this was a downstream sale, we eliminate the entire $15,000. So we reduce investment income with a debit and reduce our investment in Little with a credit. Now let's go ahead and talk about our elimination entries. Let's focus solely on the elimination entry or entries that will arise as a result of this intercompany sale. Again, we've got this nice modular approach going on where we've established first our SAID entries, then we added the effect of the non-controlling shareholders, and now we're adding this new module on top of that. So leaving aside all of the other stuff that we're hopefully fairly comfortable with by now, let's just focus solely on the effects, or the effects of this intercompany sale. So what do we need to do? Well, in the year of sale, we need to remove the gain on sale. Again, this is only in the year of sale. In subsequent years, we're going to be carrying forward that unrealized gain. Second, we need to restore the asset and its accumulated depreciation to their true values, the values that would have existed had the asset not been sold. And then finally, we're going to have to adjust depreciation expense to its true value. Now, item 3, the adjustment of depreciation expense, isn't going to apply in the year of sale in this example, since the asset wasn't sold until December 31st, 2008. That means that the 2008 depreciation expense was already recorded at the proper level. If the asset had been sold on January 1st, 2008, then we would have to adjust 2008's depreciation expense. Again, it's sort of dependent upon when in the year the asset was sold. Okay, so let's go ahead and do our elimination entries. And again, what we need to do is we need to restore the asset accounts to their proper level and eliminate or carry forward the unrealized gain or loss. So we debit the gain on sale to get rid of that. Again, this is happening on the consolidation worksheet. Big company has on their income statement a $15,000 gain on sale. We're going to eliminate that by debiting gain on sale on the worksheet. We also need to adjust the equipment account from the reported $75,000 on Little's books to the correct historical cost of $100,000. And finally, we need to put that $40,000 of accumulated depreciation back on the balance sheet. Again, when big companies sold that asset, they removed the accumulated depreciation. Our job now is to put it back on the balance sheet as though it had not been sold. And again, the second part would normally be to recognize part of the gain by adjusting depreciation expense, but that's not needed in 2008, since the depreciation was already recorded at the proper level. That $15,000 gain is going to be recognized over the remaining 3 years of the asset's life, 2009, 2010, and 2011. Okay, what about the year after sale? Let's go ahead and do our elimination entry first and see how that relates to or drives our equity method entries. Again, first our elimination entries. First thing we have to do is restore the asset accounts to their proper level and eliminate or now carry forward the unrealized gain or loss. Now last year there was a $15,000 unrealized gain. None of that was realized, so we're carrying forward a $15,000 unrealized gain. So we have to reduce or debit the investment in Little account. We again have to adjust the equipment account. It's sitting on Little's books at $75,000. The correct value is $100,000. And finally, the accumulated depreciation. Again, we need to restore that to its correct level. Put that $40,000 back on the balance sheet. Now we need to go ahead and recognize part of the gain by adjusting depreciation expense. Basically, we want to reduce depreciation expense by $5,000. So we credit depreciation expense and debit accumulated depreciation. So what's happened now, think in terms of going forward. In the first entry, we carried forward $15,000 of unrealized gain, and then we realized $5,000 of it. So there's going to be $10,000 to carry forward to next year. For our equity method entry, we've realized or recognized part of the gain by adjusting depreciation expense downwards, which means that under the equity method we need to record our share of that additional income. And since it's a downstream transaction, we get 100% of that $5,000. So again, we're going to go ahead and record $5,000 of investment income and a $5,000 debit to the investment in Little. Okay, now the next year, 2010. Now we're gonna get into sort of a groove here, a little pattern, which should become fairly consistent and reassuring. First, our elimination entries, and again, job 1: restore the asset accounts to their proper level and eliminate or carry forward the unrealized gain or loss. Again, the unrealized gain or loss is now down to $10,000. Started at $15,000. Last year we realized 5,000 of it, so the remaining unrealized gain is $10,000. The equipment account, again, needs to be adjusted from 75,000 up to 100,000. Accumulated depreciation, now we need a credit of $35,000. And if you refer to the elimination entries on the previous page, again, think of how these accounts carry forward. On the previous page in our elimination entries, we credited accumulated depreciation for 40, and then we debited it for 5,000. So we're carrying forward a net credit of $35,000. And then we recognize another $5,000 of the gain by adjusting depreciation expense. Again, crediting or reducing depreciation expense, debiting or reducing accumulated depreciation. And again, look at those two accumulated depreciation entries and see how they're going to carry forward to next year. This year, we credited accumulated depreciation for $35,000, then we debited it for $5,000, so we're going to carry forward a $30,000 credit to accumulated depreciation for next year. And another equity method entry, same as before, we've realized $5,000 of the gain, so we get to record our share of that $5,000 of additional income. The year after that, 2011, the last year. And again, first we restore the asset accounts to their proper level and eliminate or carry forward the unrealized gain or loss. We're down to the last $5,000 of unrealized gain. Again, we realized $5,000 in 2009, $5,000 in 2010, and we're going to realize the last $5,000 this year in 2011. So we carry forward the last $5,000 of the unrealized gain. We adjust the equipment account up to its correct value, and we carry forward the accumulated depreciation from the previous year, the $30,000 that I talked about a little bit on the previous slide. And again, we recognize the last $5,000 of that unrealized gain, and we do our last equity method entry to recognize, the fact that we've got this additional realized income that we get to record our share of. Now, you would think that we're all done, right? I mean, it's 2011, the asset should now be retired, it's at the end of its useful life. Let's go ahead and assume that the asset continues in use, that it's still functional, and they don't actually dispose of it. Does that mean we're done as far as elimination entries are concerned? The answer, of course, is no. Okay, so again, that should be all. Okay, 2012. What if we still own/use the asset after the end of its expected useful life? We no longer have an unrealized gain to worry about, but we still need to have an elimination entry to adjust the cost and the accumulated depreciation to their correct values. So again, we're going to have to adjust the equipment account from its reported value of 75,000 up to its correct value of 100,000, and likewise for accumulated depreciation. Sort of envision what's recorded, or what would have been recorded as accumulated depreciation. On Little's books, this asset is fully depreciated and it's got $75,000 of accumulated depreciation. If the asset had never been sold, it would be on Big's books, and again, fully depreciated, so it would have accumulated depreciation of $100,000. So what we're doing with that credit to accumulated depreciation is making the accumulated depreciation account have the balance it would have had the asset never been sold. Under the equity method, we don't have anything else we need to do because there's no adjustment to income in that elimination entry. No additional income is being recognized, so no additional income under the equity method. Okay, let's go ahead and see if maybe we have a different way to visualize this, comparing the reported and the true values. So if you want, let me just read this. If you want, it might be helpful to draw up a little table comparing the reported and true values for the asset and accumulated depreciation, and these values are prior to the elimination entry for the year indicated. So at the end of 2008 and in 2009, before we do our elimination entries, again, the reported equipment and accumulated depreciation are $75,000 and 0. The true accumulated depreciation, the true equipment is $100,000. The true accumulated depreciation is $40,000. So the adjusting entry, again, we've got the $15,000 unrealized gain. We're adjusting the equipment account upwards to adjust for that difference, and we're adjusting the accumulated depreciation. For 2010, Again, the reported values for equipment and accumulated depreciation would be 75 and 25,000. The true values would have been 100,000 and 60,000. And so what we're doing is we're adjusting from the reported to the true values. Equipment has to rise by 25,000, accumulated depreciation has to rise by 35,000. And again, we've got $10,000 of the unrealized gain being carried forward into 2010. In 2011, same drill. The reported equipment and accumulated depreciation 75 and 50. The true equipment and accumulated depreciation 180,000. So the differences would be as indicated. So what do we need to do? We need to increase equipment by 25,000. We need to increase accumulated depreciation by 30,000. And we're carrying forward $5,000 of unrealized gain into 2011, the final year. Again, if we keep this asset into 2012, what have we got? The reported value for equipment and accumulated depreciation is $75,000 each. The asset's fully depreciated. The true value for equipment and accumulated depreciation is $100,000 each. Again, the asset is fully depreciated. So what we need to do is, again, adjust the equipment upwards by 25,000, adjust the accumulated depreciation up by 25,000. The unrealized gain has been completely realized. Okay, we're almost done, I promise. I got a few last things to say. First, this was a downstream sale, so again the non-controlling shareholders were completely uninvolved. If this had been an upstream sale, the differences would have been pretty minor, but critical. First, under the equity method entries, we would only record our share of any unrealized or realized gains. 2, under the elimination entries, as we carried forward the unrealized gain from the previous period, we would have debited investment in little and non-controlling interest, instead of just the investment in little account, as we did in this entire example. Third and finally, the income to the non-controlling shareholders would have been affected by the realized and unrealized income. In fact, let's go ahead and see how this would have affected the income to the non-controlling shareholders in each year. Let's go ahead and assume that little reported income of $100,000 each year. So basically, if there were no unrealized or realized gains, the non-controlling shareholders would get 20% of $100,000 or $20,000 per year. In the presence of this transaction, again, assuming it was an upstream transaction, in 2008, they'd say, well, the non-controlling shareholders get 20% of the adjusted / realized earnings. So 20% of $100,000 minus the $15,000 that was unrealized is $17,000. And again, the idea is that $15,000 that we're deferring this year is going to be recognized over the next 3 years at the rate of $5,000 per year. So in 2009, they would get 20% of, again, $100,000 plus $5,000, or $21,000. Same thing in 2010, and the same thing in 2011. So if you look at the pattern there, in 2008 they get 17,000, so basically they lose 3,000 from sort of the baseline of 20,000, but they get it back at 1,000 per year over the next 3 years. Again, this deferral and recognition of unrealized gains is really nothing more than a timing issue. We're not going to recognize the gain now, we're going to recognize the gain at some point in the future.